Okay, let's talk about gold and silver. We have seen some absolutely explosive moves in prices lately. I mean, they've just surged, and it's left pretty much everyone asking the same question. What is really going on here?
You know what? Let's just cut right to the chase. A major asset manager, Van Eck, put out this report, and their projection for a simple ounce of gold is, well, it's jaw-dropping. We are not talking about a little bump here. We're talking about a potential repricing to over $184,000.
And it is not just gold, not by a long shot. Silver has had a blockbuster year. We're talking an incredible one-year price gain of 147%. I mean, that just shatters expectations. It completely rewrites the playbook for what a lot of people thought was even possible for the metal. So this brings us to the absolute core of what we're digging into today. Are these just crazy, speculative bubbles that are doomed to pop? Or are we actually witnessing something way more profound? Something like a deep, structural repricing of the very idea of money and hard assets?
To really get our heads around this story, because it's a complicated one, we're going to break it down into three distinct but totally interconnected forces. First, a potential global monetary reset. Second, a quiet industrial revolution that is just demanding more metal than ever. And third, a classic market squeeze, where demand is flat out overwhelming supply.
All right, let's dive into our first force. And honestly, this one is probably the most radical theory out there. The idea that the whole global financial system is quietly gearing up for a massive shift away from the US dollar. Now, to get this theory, we first have to understand a concept called the M2 money supply. The simplest way to think about it is it's just a big measure of all the cash and the easily accessible money that's sloshing around in the economy. It's the number that really shows you how much currency is actually out there in the system.
And that brings us to the core idea, which is summed up perfectly here by market expert Andy Schechtman. The theory goes like this. As people lose trust in government currencies and debt, gold is being quietly repositioned behind the scenes to become the ultimate neutral reserve asset, the thing that backs the entire system. So this is where you can see the math from that Van Eck report, and it's just fascinating. If you were to back just the narrowest type of money, what's called M0, with the world's official gold, well, the implied price is $39,000 an ounce. But if you back that much, much larger M2 money supply we just talked about, you get to that absolutely stunning number, $184,211 per ounce. And look, this isn't just some abstract theory. For decades, the US was a net exporter of gold, but that is totally flipped on its head. The country is now quietly reshoring billions and billions of dollars worth of physical bullion. That's a huge under-the-radar policy shift that really suggests something big is happening. Okay, let's move on to our second force. This one is less about financial theory and a lot more about tangible, physical demand for these metals, especially silver, which, believe it or not, is going through its own industrial revolution.
And this chart really shows you the key difference between gold and silver. See, gold is mostly a monetary thing, or it's for jewelry. But silver? Over half of all the silver that gets mined is actually consumed by industry. It gets used up, it's gone, you can't easily get it back. And that creates this constant demand that basically puts a hard floor under the price.
The whole green energy transition is a massive, massive driver of this. Solar panels use a ton of silver. And as you can see right here on this chart, the demand from just this one sector, well, it's projected to just keep on exploding. But here is a potential game changer. There are new electric vehicle battery designs about to hit production, and they use way, way more silver. The math on this is just staggering. If only 1/5, just 20% of EVs adopt this new tech, the silver they'd need would equal the entire world's annual mine supply. I mean, there's just no way that level of demand can be met at today's prices.
So all of this brings us right to our third force, a classic supply and demand crunch. When you take the monetary demand and the industrial demand we've been talking about, and you smash them up against a really tight supply, well, you get the perfect recipe for a market squeeze. So here's the crucial point. The silver market has been in a structural supply deficit for 5 consecutive years. That means for 5 years straight, the world has used more silver than it has mined, and we've been draining all the stockpiles that are above ground. A deficit for 1 year is a big deal. A half-decade deficit is a pressure cooker just waiting to blow.
And a key player in this whole squeeze is China. For years, China was just quietly buying up and hoarding massive physical stockpiles. Then, for a while, they were the world's marginal supplier, selling just enough to keep a lid on prices. But recently, that's stopped. China now sees silver as a strategic resource, and they're not selling anymore. That has removed a critical buffer from the global market. Now, you might be thinking, okay, if the fundamentals are this strong, how do you explain a headline like this? An Indian silver ETF crashed 24% in a single day. How is that even possible? Well, this is a perfect example of the disconnect that can happen between the paper market and physical reality. What the headline screamed was a crash was actually just a correction. The physical price of silver barely even moved that day. The thing that moved was the price of a financial product that had just gotten way out over its skis. So here's the quick version of what happened. Speculators were betting that India was going to raise its import tax on silver, so they bid up this one specific ETF way, way above the global price. When the tax hike didn't happen, poof, that speculative premium just vanished. The ETF price simply fell back in line with the actual physical price. So it wasn't a silver crash, it was a paper market correction. Big difference. So how do these three forces, the monetary one, the industrial one, and the supply squeeze, how do they all fit together to create this perfect storm we're seeing in the market right now? Well, it works kind of like this. The threat of a monetary reset drives this powerful safe haven demand for physical metal. At the very same time, that industrial revolution in green energy and tech is just eating up the physical supply at a faster and faster rate. And all of that exposes and amps up the market squeeze, which has been building for years because of those deficits. See? Each force just feeds on the other. After breaking down these powerful, interconnected forces, what's the single most important idea to walk away with from all of this? It might just boil down to this old saying. Whether you're talking about nations getting ready for a new monetary system or industries scrambling for strategic resources, the theme underneath it all is the growing importance of physical ownership. The power is shifting to those who hold the actual asset, not just a paper promise of it. And that leaves us with the ultimate question, doesn't it? Is this just another temporary rally fueled by speculation? Or are these three forces coming together to signal the start of a much bigger structural reset? A world where owning tangible, hard assets becomes more critical than it has been in our lifetimes. And that, well, that's the multi-trillion-dollar question for all of us to think about.